A white plume rises over the Sistine Chapel. Robert Francis Prevost steps onto the balcony of St. Peter's Basilica, the first American-born man elected pope in 2,000 years of Catholic history. The crowd in the piazza is enormous. The moment is historic. 3 weeks later, he is legally required to file a U.S. tax return. Here's the specific problem. As head of the Vatican, Prevost has signature authority over Vatican bank accounts. Under U.S. federal law, any American with signature authority over a foreign account holding more than $10,000 must file an annual disclosure report with the Treasury Department. Miss it, and the penalty isn't a fine. It's 50% of the account balance per year. The Vatican Bank holds billions. The U.S. government, by the strict mechanics of its own law, holds technical claim over a 2,000-year-old institution because the man elected to run it was born in Chicago. A sitting U.S. congressman introduces a bill specifically to exempt the Pope from U.S. tax law, because without that bill, the law applies. He lives in a sovereign city-state. He hasn't lived in America in decades. The IRS doesn't care. America taxes its citizens who live abroad. It's annoying, maybe a little unfair, but manageable. You file a form, claim a credit, move on. Here's the crack in that story. The US is one of 2 countries on earth that taxes citizens regardless of where they live. The other is Eritrea, a one-party dictatorship the UN Security Council formally condemned for doing it in 2011. Eritrea charges a flat 2%. The US charges the full progressive rate, up to 37% on worldwide income for life. Rob Gerritsen is 63, retired, lives in Amsterdam. He was born in New York in 1957 while his father was working at a bank back in the Netherlands before his 2nd birthday. He pays Dutch taxes. He votes in Dutch elections. His passport is Dutch. In 2014, his Dutch bank sent him a letter. Produce a U.S. taxpayer identification number or your account closes. If the law is broken for the Pope, it's broken for Rob Gerritsen. And there are 300,000 of him across Europe alone. This isn't a tax policy story, it's a 3-stage trap. Stage 1, citizenship-based taxation. You owe the IRS wherever you live. Stage 2, an exit tax on your entire net worth if you try to renounce. Stage 3, a global bank surveillance network that turns the citizen's life into an open file. Each stage closes a door, the last one left open. There's a number buried in this story, $14 million. Hold on to it. It's 1862. Washington is running out of money and men. The Union is a year into a war it expected to win in months. Congress passes the Revenue Act, the first federal income tax in U.S. history. Most people know that part. What they don't know is what's buried inside it. A special 5% surcharge on income earned by any U.S. citizen living abroad. Not a tax on what you earned. A tax on where you chose to live. The reason wasn't philosophical, it was draft evasion. Wealthy Americans were crossing into Canada to avoid conscription, the ones who could afford to go. A town in New Brunswick was literally renamed Skedaddle Ridge because so many of them settled there. Congress's answer was to make leaving expensive. You fled your civic duty. You paid a higher rate on whatever income you still drew. Citizenship-based taxation wasn't born as rational tax policy. It was born as a wartime punishment for exit. The 1864 revision locked that logic into the code. It's still there, 160 years later. But punishment isn't the same as constitutional law. For that, they needed a court. It's 1924. George Cook lives in Mexico City, permanently. He owns Mexican real estate, earns only Mexican source income, and has no meaningful connection to the United States beyond his passport. He pays U.S. tax under protest, then sues for a refund. His argument: taxing a citizen domiciled abroad on purely foreign income violates the Fifth Amendment's Due Process Clause. He takes it to the Supreme Court. The court rejects him unanimously on May 5, 1924. Justice McKenna writes the opinion. His reasoning: government by its very nature benefits the citizen wherever they are. Citizenship itself is the taxable event. Where you live is irrelevant. Consider the world McKenna was writing in. No commercial jet travel, no internet. Derivative citizenship laws, the ones that automatically make children born abroad to one American parent into U.S. citizens, barely existed. A U.S. citizen abroad in 1924 meant a handful of industrialists and the occasional diplomat. McKenna wasn't writing a rule for 9 million people spread across 110 countries. That ruling is 102 years old. it has never been reconsidered. It's the only thing holding the entire modern system together. The architecture was built to punish exit, not fund government. For 80 years, it stayed mostly theoretical. Then, Congress built the first real enforcement layer and hid it inside a bill for veterans. It's June 17, 2008. President Bush is signing H.R. 6081, the Heroes Earnings Assistance and Relief Tax Act, the HART Act, tax benefits, pension protections, survivor payouts for U.S. military families. The House passed it 403-0. Nobody voted against it. Who could? Buried in Title III under a section blandly labeled Revenue Provisions is Section 301. It creates something called IRC 877A, the mark-to-market exit tax. The mechanism is this. On the day before you renounce your U.S. citizenship, the IRS deems you to have sold every asset you own, anywhere on Earth, at full market value. Your house in Amsterdam, your pension, your investment account, your share of a family business, all of it, liquidated on paper. Gains above $890,000 taxed at capital gains rates. You pay tax on money you haven't received on a transaction that never happened. There's a legislative logic here worth understanding, because it's the same logic as 1862. The HART Act needed a revenue offset, a way to pay for the veterans' benefits on paper. Congress paid for it by taxing people who tried to leave the U.S. tax system. The two have no moral or logical connection to each other, but stitching them together made both pieces politically untouchable. You couldn't vote against one without voting against the other. The exit tax was designed to be invisible, no standalone debate. No public hearings on the merits of taxing people for leaving. It rode into law inside a bill named after soldiers. Boris Johnson found this out the hard way. Born in New York in 1964, left at age 5, never lived in America again. In 2014, as mayor of London, he sold his first London home. Under UK law, no capital gains tax applies to the sale of a primary residence. The IRS sent him a bill for several $100,000. Johnson initially refused to pay, eventually settled in 2015, and renounced his U.S. citizenship in 2016. He concluded the only rational move was to pay to leave. The system is telling you something about itself. But Boris Johnson had the money and the lawyers to navigate the exit. Most people caught by this system don't look like Boris Johnson. Fabien Lehagre was born in California in 1984. His parents brought him back to France when he was 18 months old. He grew up French schools, French taxes, French bank account, French life. In 2014, that bank sent him a letter. He had 90 days to produce a U.S. taxpayer identification number or lose his account. He didn't have one. He'd never needed one. He didn't know he was a U.S. person under federal law. He founded the Accidental Americans Association and sued France, Belgium, Luxembourg, and the U.S. State Department. His case is still moving through courts. His account is still at risk. The U.S. treats him identically to an American resident hiding $10 million offshore. The people building the renunciation queue, 30,000 of them now, some waiting years for an appointment, aren't tax cheats. They're Rob Garrettson. They're Fabien Lehagre. They're people who want a bank account in the country where they actually live. From 2014, the State Department charged $2,350 to renounce, the highest expatriation fee in the world by a wide margin. The exit tax turned renunciation from a right into a financial transaction. Then, the State Department raised the price of the transaction. But a sealed exit door only matters once you've built the system designed to push people toward it. That system came 2 years later. It's March 2010. Congress is debating the HIRE Act, the hiring incentives to restore employment, a jobs bill, post-crisis stimulus, the kind of legislation that passes with bipartisan support because the name is the argument. Buried inside it, the Foreign Account Tax Compliance Act, FATCA. No standalone hearing, no public debate on its merits. The same legislative architecture as 1862, the same move as the HART Act, a punitive mechanism stitched inside a sympathetic bill so nobody has to vote for it directly. But FATCA is different from anything that came before it. It doesn't go after Americans directly, it conscripts every bank on earth. The mechanism is this. Any foreign financial institution, any bank, brokerage, insurance company, or investment fund operating outside the United States must register with the IRS, obtain a global intermediary identification number, and report the details of every account held by a U.S. person. Name, balance, activity, automatically, annually. If the institution refuses, The U.S. seizes 30% of every dollar flowing to that institution from American soil. Dividends, interest, gross proceeds, all of it withheld at source. A 30% withholding on U.S. source payments isn't a penalty. It's commercial extinction. No serious bank can operate in global capital markets without access to U.S. dollar clearing. There's no opt-out. The 30% is a gun to the head, and every bank on earth eventually put their hands up. To get around local bank secrecy laws, which in many countries literally prohibited handing customer data to a foreign government, the U.S. Treasury negotiated what it called intergovernmental agreements, IGAs, with over 110 jurisdictions. Foreign governments became the middlemen. They collect the data from their own banks under domestic law and pipe it to the IRS. No warrant required. No notification to the account holder. The pipeline runs whether they know it or not. If you have savings in another country, not as an American necessarily, just as someone with a foreign bank account, your institution is almost certainly already registered with the IRS. 110 jurisdictions report to Washington. This isn't hypothetical infrastructure. It's running right now. After FATCA went live in 2014, Rob Garrettson's situation stopped being unusual. European banks started closing accounts held by anyone who looked like a U.S. person and couldn't produce documentation proving compliance. The bank's calculation was straightforward. One non-compliant U.S. person account exposes the entire institution to the 30% penalty. By October 2019, the French Banking Federation was warning that up to 40,000 accounts could be closed before the end of that year alone. FATCA was sold to Congress with a revenue projection from the Joint Committee on Taxation, $8.7 billion over the first decade. That's the number that justified building a global surveillance infrastructure. The Treasury Inspector General audited the results in 2022. Actual revenue generated from FATCA-related assessments, $14 million, not $8.7 billion. $14 million. The system cost the world's banking industry an estimated $8 billion a year in compliance costs. Scotiabank alone spent roughly $100 million, and it raises 0.2% for the U.S. Treasury. The revenue was never the point. The data was. What FATCA actually built is a comprehensive automated financial map of every U.S. person holding assets in 110 countries, updated annually, delivered without a warrant. The $8.7 billion projection was the cover story. The product is intelligence. FATCA isn't a tax enforcement mechanism. It's a data acquisition system. And once you see that, the last layer of the architecture stops looking like a contradiction. Here is what the United States told 110 countries. Send us everything. Names, balances, transaction histories, annually, automatically, or face 30% withholding on every dollar you touch from American soil. In 2014, the OECD built a reciprocal version of that system, the Common Reporting Standard. Same automatic reporting, same global reach, but every country that joined would both send data and receive it. A genuine exchange. The United States refused to sign. FATCA was the official reason. FATCA already handled it, Washington said. What they didn't say, FATCA is a one-way pipe. The U.S. receives. It does not send. Foreign governments trying to track their own citizens' assets held in American accounts get silence. That's not an oversight. Here's what it produces. The Tax Justice Network's Financial Secrecy Index ranked the United States the #1 financial secrecy jurisdiction on Earth in 2022. Not Switzerland, not the Cayman Islands, the United States, which increased its supply of financial secrecy by 31% between 2020 and 2022. South Dakota alone holds an estimated $500 billion in trust assets, sheltered by trust laws so favorable that the money that used to flow to Zurich now flows to Sioux Falls. A wealthy Brazilian hiding assets in the Caymans has those assets auto-reported to Brazil through CRS. A wealthy Brazilian hiding assets in South Dakota does not. The U.S. is the terminal destination for the wealth fleeing the transparency it forces on everyone else. Remember, $14 million. That's what FATCA raised. The system that cost the global banking industry $8 billion a year to run, that closed Rob Garrettson's account in Amsterdam. that sent Boris Johnson a bill on a house the UK didn't tax that made Fabien Lehagre prove his citizenship to keep a savings account he'd held his entire adult life. It raised $14 million. For context, the US government spends roughly $14 million every 66 seconds. The system demands full transparency from 110 countries and operates as the world's largest onshore tax haven for everyone else. The drawbridge opens one way, and the people in the 30,000-person renunciation queue are still waiting. Rob Gerritsen found a smaller bank willing to absorb the compliance cost. He's still in Amsterdam, still on the reporting list. Fabien Lehagre's lawsuit is still in court. In December 2024, one congressman introduced a bill to shift the U.S. to residence-based taxation. It's awaiting a revenue score. The earliest it takes effect, if it ever does, 2027. The system isn't broken. It works exactly as it was designed to work.